Well, hello, everybody, and welcome to today's webcast brought to you by Regiment and Cogent Law. We're excited today because we're going to be talking about what investors expect before the first capital conversation. This is sort of an interesting area, and I want to welcome Jack Baumann on with us. We're going to be talking about these things today. So we'll give you a little bit about our background and a little bit about our company's background. And in the meantime, I just want to let you know you guys are on Zoom. So with Zoom, you want to make sure that you know that the Q&A is open, so question and answer. So as you put questions in there, we're going to try to address those live. And worst cases, we might table them to stay on track till the end of the session. So with that being said, I mentioned my name. I'm a Chief Revenue Officer, and I'm a senior partner here at Regiment Securities. It's an investment bank based out of Chicago. Um, I love how they grace. I think we just keep it at that number, Jack. It's just over 35 years of experience. It doesn't disclose then how old we are. But just to give it away, I started at
Good.
Merrill Lynch, 1982 in the Board of Trade. So if you can do the math, you know it's well over 35 years. But there's a lot that's happened since then in the capital raise space, and I'm excited to say I've been in most all of it, and I've always owned tech companies. So my background is technical in nature, but always had to do with surrounding capital and work at inside institutions and outside institutions, et cetera. And at Regiment, we utilize a lot of technology to do that, but I'll get into that when we get to the regiment slide. But Jack, give a little bit about yourself.
Sure. And yeah, I'm well past the 35-year mark too. I think my law school class at Harvard just had its 40th reunion, which I didn't make it to, but yeah, I've been doing this for a few years myself. Started as an M&A lawyer at Skadden Arps, New York, where I was for about 6 years, doing a lot of large cap, mega cap, corporate M&A transactions, as well as a number of financings. Worked closely with some of the hedge funds of the day, the Julian Robertson Tiger funds and what have you. And I've also spent time in-house on the other side of the fence as chief legal officer of several public companies. The most recognizable of which is Public Storage, where while I was there, we doubled the size of the company, ran a hostile acquisition of our biggest competitor, SureGuard, and I'm back in law firm life at Cogent. Just a word on Cogent. We're a national law firm, but we operate remotely. We were remote and outside of the office even before the pandemic, and we try to pass some of that cost savings through to client base with attractive billing rates. But I am licensed in New York and in Florida, and I head up the South Florida office for Cogent, currently based in Fort Lauderdale. So, and it's my honor and privilege to be able to spending time with you today, along with Dean.
Yeah, absolutely. So at Regiment, I always like to think of this, we're the matchmakers of capital. So we represent issuers. So an issuer is if you're a founder of a business or you're the issuer of any type of security into the marketplace with the intent to raise capital. And we can't do it without Jack and his team and people at Cogent because they take care of all the legal, all the filings, everything like that. But once that's done, then we get them, sort of propped up and ready for capital, which we're going to talk about today because that's a important piece. We also represent Cap Intro. That means we represent hedge funds, family offices from all over the world that are looking to place their capital in specific issuers. So they're looking for deals, they're looking for alternative investments. We don't do trading or anything like that. We're pretty much a deal shop, if you will. So that's what makes us up. And then we're pretty heavy in the IPO space in the world, as well as Cogent is with you've seen a lot of the IPOs coming off. And we have a distribution of about 50 million globally brokerage accounts where, and if an IPO goes off and we're part of it, we can actually market that for indications of interest and get pre-orders from the general public, just like you. So it's like, what's nice is a lot of times Goldman and those guys will hold out these IPOs um, you know, for all the other hedge funds or all the other banks or their buddies or their clients. And it doesn't come down to us. Well, now that world is changing. And so that's a whole new world too. And so that's why we're excited to work with Cogent because they also work with IPOs.
Well, and Cogent, just to add to Dean's kind words, we're a firm that works primarily, with I would say small to mid cap issuers for the most part, anywhere from about 10 million to 100 to 150 million thereabouts, or sort of the sweet spot for the client base. We certainly work with a number of clients who are larger than that. And in my past history, as I mentioned, of work with some significantly larger firms, but that's kind of the sweet spot, and what we aim to do in connection with the transactions that we work on, whether it's a financing or purchase or sale of a business. We try to ensure that the legal documentation and agreements are structured in such a way so as to protect the value of the deal that the client is seeking to achieve. If you're on the buy side, we like to have strong reps warranties in the transactions, and ensure that the buyer gets what they're paying for. And on the sell side, same thing, just the flip side of that. But as I said, we're national, and as well as work on international transactions as well.
Yeah, that's great. So, all right, enough about us. Let's get into some dialogue here to help the folks that are listening in. So, some talking points that Jack and I put down. We always base it on common questions that people ask us, and we think about, why do investors disengage before the first meeting ever happens? Like what causes that, And I think there's a couple of misconceptions out there that people feel, oh, I have this amazing product. And, founders are always proud of their product. I've been a founder many times over, and I'm sure I've just overstepped my boundaries and just talked all over the place at one point in time before I learned how to do it properly. But sometimes, too much is too much, and what'll happen is people get lost, they get confused easy. We have to remember that they don't know who you are most times. And if they know who you are, they really don't know how your business operates. So there's a lot of places that they can get disconnected, whether it's from a deck or a one pager or a website or whatever it is, and they just can't figure it out. And to them, it's too confusing. So they don't want to be part of something that's confusing. But and incomplete information is another thing. But Jack, what do you think on this topic?
No, I agree with you, Dean. That a lot of founders think that the M&A starts when a banker is hired or a deck is prepared, but and the deck is certainly very important, and we'll talk about that a little bit later. But I think first and foremost, the first thing that investors evaluate is the person, the founder who really represents the organization, before they even focus on the product. Uh, Trust is built in a variety of ways. Typically, they'll be interested in the background of the founder, and there's almost a formula. You could start with the founder typically in a smart presentation or approach to investors will Will identify their strongest credentials and give quantifiable examples of things that they've done before and that they have the capability of being able to do again. One of the first questions that that investors do ask is, have they done it before, and can they build the product that they're actually looking to build and to grow, and do they have relevant wins, or not just wins, but things that are relevant to the current business. So those are all foundational, before you even get to the deck, which needs to be tight, and it needs to have all of the operating information, legal disclosures, and uh, all the other legal disclaimers and things like that. But it starts with the people.
Yeah, and to that point, so a lot of people are probably scratching their head going, what if this is the first time, right? What if this is the first time I decided I'm gonna buy this company and take it to the next level, or start this company, and I know how to operate businesses. So let's talk about what we call bridging. Okay, so what'll happen is they look at you and they want to know that um, you know how to responsibly run a business. Think about the basics, right? You understand accounting, you understand a P&L, you understand a balance sheet, you understand uh, how your widgets or whatever it is that is made, right? So a lot of people, they just want to know you know what you're doing as it relates to the business. And let's just say you don't have a track record. This just happened to me with one of my companies is we have a resort property, and all of a sudden, we hit water on the property, and it's 100-year water artesian well. And all of a sudden, I'm looking around the room and I'm like, well, we don't have any water people. Nobody here knows, other than drinking a bunch of it. We don't know much about water. And some people knew a little bit, but not a lot, right? So we went out and hired some water experts on the team, and lo and behold, that just leapfrogged us right out of the gate. So the team counts, right? So they want to know that you, as a founder, and if you're running the company as the CEO, that you know how to run a company. You know how to responsibly manage money. You know how to responsibly grow the business. Jack, you mentioned, I think, gaining traction. You know what that looks like. You know how to scale, right? So I think that's one of the big things that seems to pop up is not just look at yourself, but look at the team. And just because I'm a tech guy, I'm going to go down this road a little bit. Please make sure that when you type your name into the internet, and let's just say you have a common name like Jack Smith, maybe not Jack Bauerman, but you type your name into the internet and people find your LinkedIn profile, your website, they find all kinds of old things about you, that the story is consistent, that you're telling about yourself with what people see on your digital footprint. I've seen that kill more deals than none, because people are like, oh, did you Google that person? Did you see what I found? So, and it may not even be you. You just need to be aware of what's out there with your name on it. So that's another big thing that really pops up. And I'm sure you've run into that, Jack, where all of a sudden people are like, how can I fix
Oh,
this? It's not me.
yeah, certainly have. And investors will look, they'll look at the lead person. They'll also look at the team
Yeah.
that the founder has put together and built around him, and the credentials of the team, the background, the relevant things that they bring to the table that can help this company succeed. And not just the internal team, but they'll look at the external team too. They'll look at the legal advisors, they'll look at the bankers, who are on the team, and look at, again, their backgrounds and experience as well. So there's a real evaluation process that goes on. And as Dean says, sometimes there can be confusing information out there, maybe incorrect information out there, but it's in the run up, to a capital raise, to the extent that any of that's manageable. If there's any bad information or outdated information about you, or wrong information, it'd be a good idea to do what you can to try to clean some of that up. Yeah,
Yeah.
if possible, as part of the run up.
Yeah, got it. Um, well, let's transition into one of the next topics we have here, the difference between being pitch ready and capital ready. What's your thoughts about that?
Well, pitch ready in my world, and I think more broadly, means having a compelling narrative, a compelling product, something that you believe that is going to have a hook that people are going to want to learn more about. It addresses a problem, fills a niche, in an industry or a gap, brings a solution. Capital ready is a little bit different. Capital ready is, that requires more um, data that you pull together, and putting the correct structural and operating, or having structural and operating readiness. For example, a lot of venture capitalists will look at the corporate structure. They'll look at things like, whether you're a C corp or an LLC. Nothing against LLCs. I've owned several myself, but sometimes C corps for capital raise are a little bit more popular. Delaware is always, popular in some circles. As I think Dean would agree, the if you can stomach the Delaware franchise taxes, but certainly investors and people like that, they respect they respect Delaware. And you need to have a well-organized data room. I mean, that is critical. That's something, that, you need to have the links ready. You need to have the key information readily accessible, such that people can navigate to it, without, undue drama. And, you need to really give the impression, that you're ready for prime time. Corporate hygiene in some respects, it's boring, it's dull. People hate the sound of corporate governance or lawyers, but in some ways it signals adult supervision and that there are people in the room who know what they're doing.
Yeah, it goes back to that founder knowing how to run a business, right? It's a direct reflection on them. So I mentioned to you before, Jack, that I have two terms that we use inside the bank. One of them is called shovel ready. So what'll happen to us is an issuer will be all excited about their offering and they go, "We have a deck, we have a data room, we're all ready to go." I'm like, "Slow down." So we have a scoring system by which we score and give them critique and etc. And our goal is to get them shovel ready. Now, let's say they're a Reg D 506B, which means they're not planning to generally solicit, but for the most part, they want accredited investors. It's still a security. So you need to be shovel ready in the sense that I could take your deal, walk it over to one of my hedge funds or my private equity or my VC guys or high net worth family, and they can get it. We can tell the story, they can get it, and the story is that clear to somebody that knows nothing about your business, right? It's funny, I was working on a project with inner city schools and whatnot, and I was like, they were raising capital, and I said, well, go into the high school, and I said, I want you to do the pitch in front of your kids and have them tell you if they would invest in the company. And so we got some really good feedback on that one, and we were able to change the pitch deck. But a bunch of high school kids really set them straight in terms of what was digestible. The second phase is called street ready. That means that you are ready to go to the public. That if you want us to advertise, which takes budget, um, you want us to advertise in the world, whether it's doing maybe events, maybe it's doing Jack and I have done a lot of family office events, and a lot of issuers are there. And it's amazing to me the number of people that are not street ready. They're just not ready to take capital, and they're burning dollars trying to get people to be interested, and nobody is biting. The first indicator is within that first 30 days, and you're always going to have adjustments, but pay attention to your numbers, your appointments, your meetings. whoever's your investor relations person, make sure everybody's on the same page with what the goal is and what you're trying to bring in the door. And that's where a lot of people, I think, go wrong.
No,
Um,
I think that's an excellent point, Dean. I would add to that, another thing that, telegraphs and signals to people that you really are ready to take the next step and to take capital in and deploy it responsibly is demonstrating a real awareness of what the relevant regulatory framework, for example, may be in the business that you operate in. Cogent happens to, in addition to the broad corporate work that I do, which straddles a lot of industry. I have colleagues who focus on fintech, which is a very evolving area. A lot of digital assets and there's legislation working its way through Congress now, which is going to have a significant impact on that. Demonstrating that your structure and that your advisors, are appropriate and very informed with respect to those type regulatory issues, critical. In other areas, cannabis and cannabis banking, we also have a practice that works in those areas as well. Again, very evolving, and you need to have a team, that's knowledgeable and able to pull in the right disciplines.
yeah, that's excellent. Well, I'm gonna jump to the fourth one because I think this one is one that isn't talked about enough. We could probably spend a whole hour telling horror stories about this, but where founders overshare or undershare in ways that create risk. Now, if you have Mr. Bowerman and his team put together a PPM for you, a private placement memorandum, and you file with the SEC, you'll notice in the front of the document, there's probably an equal number of pages that talk about the risk of the deal versus, what the deal is. And Jack, I'm sure you've seen some that maybe even go overboard, but the idea here, I'm sort of curious of any stories, and of course we don't want names, but I have a dozens of stories on this about where founders overshare, undershares in ways that create risk.
Oh, no question about that. Typically in many private placement memorandums, you'll have a section. It's specifically called risk factors, and it can go for 10 pages in a private placement memorandum. A lot of it, smaller, typeface and what have you that basically tells you all the ways that something can go wrong, in connection with the investment. And people do it. The reason it's there is, to cover the butts of the founders and, to avoid, liability on behalf of the, company. But it's also to, really educate, the investor and make sure they have a clear-eyed picture of exactly what it is that they're investing in, who the competitors are, what the regulatory risks are, or any relevant litigation, things like that. And sometimes people do go overboard. And as Dean said, there really is such a thing as oversharing there, and striking the right balance is difficult. I mean, an undershare can lead to liability. Overshare can just turn people off and scare them off. So it's a real balance, and it involves typically the legal team working closely with the operational team and making sure that the risk factors and disclaimers are right sized to the business.
You always say you want to pay your legal team to properly set up your offering, not defend your offering. So just think about that, right? Um, I can't tell you. I like I said, I could go on and on about this, but we would have a founder that would notoriously get excited about things in the company because what happens is we'll create a roadmap. This gives you the confidence that if you're coming in, you know that every quarter, every year, this is the intentional roadmap. No guarantees, but this is a roadmap that we're on. And let's just say it shows certain events, and then what would inevitably happen is in a you know, and we try to coach them on this, but they'll start using terminology that just you know, sort of puffs up the deal bigger than what it is, right? So that they will just start using, pronouns and adjectives that just make no sense because they're saying how they're the best. This is the only one. This is, so that'll slip out because in their heart they believe that they're the only one, or they believe that, and so that happens a lot. Also, um, they'll start changing the roadmap in a story that they're telling while the pitch is going on. So they get comfortable and they loosen up a little bit. And then all of a sudden, while they're talking through the company and the pitch, for instance, this just happened, or we're going to be doing this. And all of a sudden, it's not on the roadmap, and you have a bunch of questions. And then capital comes to a screeching halt. And people are like, man, it just sounds like they're all over the place. And they really, like we talked in the beginning, they want to know that that founder knows exactly what's going on. So, it's crazy.
Classic example of those type things. Even someone who is as experienced and as savvy of a founder as Elon Musk, has had some notoriously questionable disclosures that he's made or shown up on investor calls with some people believing, not saying he was, but some people questioning whether he may have had something he shouldn't have before the call started, uh,
Or
and making
before the tweet was sent.
and making absolute statements that could cause a run up or a decline in the stock price. So people need to be very careful. The lawyers get a bad rep for reining people, reining business people in, but sometimes there's a reason for that, and oftentimes there, is a reason for that. But it can be very colorful along the way.
Yeah, and man, it's probably why I don't have any hair left. But I have an issuer that's up tomorrow on a webcast, and I'm literally spending an hour with him this evening again, going through his pitch just to make sure we're crystal clear because it's so easy when you know so much about your business or your industry for you to start talking and to branch off, right? And then it makes you sound like you're not on track, you're not on a clean story. So, uh, and the other thing is we'll take and we'll outline a script. Jack has seen this. I outlined today a little bit because, as an investment bank, we have to turn everything into compliance. So, we do that with our issuers as well. And that's why it's important that if we all agree this is what's going to be said, this is submitted and approved, we don't go off of that. We don't veer off of that. And so that's an important fact too. Or else you have to go to Jack to defend you. Everybody shows up with pitchforks and torches. So
Yeah, yeah. Ideally, we want to keep the litigators, away from your deal, and you definitely want to stay in the corp fin side of the SEC and not the enforcement division.
yeah, keep them on the setup and on the growth, right? So they're there to help you set up and grow, not don't get caught up in defending because then you don't grow because you're distracted. So uh and we've all been caught there, myself included. I wrote a book about this. It's on Amazon. You can read about a lot of my failures in that book. So just put my name in there. Um But I've learned a lot too. I listen to guys like Jack now when I didn't used to. When I was younger, I didn't listen to anybody. So that was my problem. So listen to your advisors. That's the other thing. We're telling you things for a reason. Just go, don't walk away and go, oh, he doesn't know what he's talking about. So this sort of dovetails into the next one, how inconsistent messaging quietly erodes confidence, right? And so this goes to a little bit about what we said about whether it's PR, whether it's the pitch deck, whether it's addendums and upon addendums and agreements, be careful of those. Those can, just cause people to go down a dead end because they're reading so many addendums, they forgot what the original deal was. Um, and then just again be consistent with what you say versus what's written. I think that's one of the biggest things. But Jack, what do you see, on the law side that where this comes up?
Well, to your point, Dean, I think the key word there is consistency. Once you have your approved script, or your pitch, uh, to stick to it. And that extends across your deck, your website, LinkedIn pages, email footers, such that, you're using the company name consistently in all respects. And, even things, such as having a up-to-date privacy policy, security policies, all of these things on your website, it all adds up, to a picture that, either, will resonate for people and show that you're professional and that you have brought in professional advisors to make sure that these things are double and triple checked and locked down, and consistent, and that the messaging stays the same. And then once you're on message, just do your best to stay there. It's not always as easy to do as you'd like, and sometimes you'll have to chase that rabbit that runs across the field on an investor call or what have you. But you try to do the best you can, and try to anticipate those as best you can.
Yeah, and it again, I think more people get caught up than not. I think let's take this live Q&A because it's sort of timely in how this is written. But it says, from your experience, what is the single most common structural or governance mistake founders make before raising capital that ends up materially impacting valuation or control, and what should they be doing differently 12 to 24 months in advance? Good question.
I've seen some people get mired in having, a lot of people use safes. Venture capitalists love to use simple agreements. They call them simple. They're, legally very dense, but safe is something that, VCs will like, and there are some established forms. Some of them are very aggressive. Some are not. But they can really tie up the capital structure of a company, particularly if it's not done professionally, if it's not done right, if you've got too many safes with friends and family, or small investors, or litigious investors, or noisy investors. These are all things, that can really constrict and constrain your ability to raise capital, because your cap table is tied up, in one way or another, and you really end up surrendering leverage in the process. To the extent you're, working with your bankers, and trying to price a deal the right way, and obtain the right return. If you made some of those early mistakes when you were not being so professionally advised, I've seen that, cause founders to leave significant money on the table.
Yeah, I was gonna say too, this comes up for me is I always say be careful of your assumptions, because a lot of times we'll do pro formas and things like that, and there's assumptions that are built in there. And so, sometimes too many assumptions will increase the risk on a deal. I assume these 25 things are going to happen, and then all that has to happen for me to make my money or get my capital back. That sort of feels sketchy to me. So just watch that side of the piece. And you mentioned the safe. Yeah, I don't know. Are those still working okay? Because the ones I saw were like, oh, so sketchy.
I've never been a fan of them. I think that was a Silicon Valley, creation that took on a life of its own. I've never been a big fan of them myself. I think that there are ways to structure a Series A or a Series B and skip over and past the safes. I've always found them to create regulatory issues as well, and people get somewhat confused in them, getting things right on the securities laws. So, and they can be very, very VC friendly and not very investor or founder company
Yeah,
friendly.
nice. Jerica has a question in here. Any thoughts on how founders should engage with other types of business project leaders and managers? Great question. So, what we do is to prepare somebody for a capital raise is we actually have them do what's called a network map of all the people that they know, all the organizations that they know, and let's map out sort of the current state network. And this is how we've gotten to this moment in our business, right? So you're literally it could be any format you want. It could be a whiteboard, it could be a blank sheet of paper, and you're just mapping out all the relationships that you have, organizations, people, maybe people from school, alumni, whatever. Um, and then what's interesting about this is then what we do is we create an ideal state network, right? So if you really are, if you're raising $20 million or whatever it is you're raising, there's a certain element of the people around you that you could empower, and we call this your team, that you can empower on your team to actually break apart be those leaders that help bring in some of that capital that you need early on in a cap raise. And a lot of times we'll start there. And if you engage Cogent, they have a network, right? They should be on that map. If you engage us, we should be on that map, and we're all in this together. It's not like, oh, I'm just going to hire a regiment and they're going to raise capital for me. No, we want you to be responsible at raising and managing capital. That's the most important thing here. And then what you do is you just draw, an ideal state action plan between the two. What actions do you need to take to meet these people? Do you need to go to different conferences? Do you need to go to your LinkedIn and see who you're really connected with? Can you find some of these people in more alumni? If you reach out to the alumni that you know, or you go on LinkedIn and you look at your alumni there. But maybe you belong to a club. It's good to go in your club that you belong to, and whether it's golf, country club, city club, whatever, and figure it out from there too. There's a lot of people that are always willing to connect you to somebody. Jack, what do you think about that?
No, I would second what you say, Dean, and I think I'm not someone who has always loved going to conferences, but I think for a business leader, I think it can be really critical both to stay current, see what the competitors are doing. You get the Consumer Electronics shows, one famous example every year in Vegas where people see what the next things are that are, coming on the horizon, in their industry. And it can also be an opportunity to meet people, who, could potentially, be useful to you in your supply chain, as a supplier or as a potential customer, down the road. So I think, those type of events that bring people within a particular industry together, they can pay great dividends. And I think making time in the calendar a couple of times a year for things like that is generally time and money well spent.
I agree. Well, the questions are coming in.
I see one on related party transactions,
I know,
from
right?
Thomas. And he points out that they're a red flag, especially if they're poorly documented loans or ongoing vendor relationships. Yeah, related party transactions are always something that we focus on the legal side. At a bare minimum, disclosure is critical. And to the extent that you can avoid them or set guardrails, around the types of third party transactions that you can enter into, and have full disclosure at the board level. Oftentimes, it's very key when you're talking about a leader, and companies, will, and that will be, limited not just to, their own securities, but securities of suppliers and what have you, and that you might have an interest in, or that founder might have an interest in. It's uh, ultimately disclosure is helpful, but there's even disclosure doesn't cure all sins. Um,
Yeah, I know. It's a fact. It's interesting. The piggyback question there was compared to 24 months ago and 12 months ago. Can you quantify any shift you're seeing? So, the thing with the market is there's macro and micro shifts going on all the time, right? So, I always have the market boards up. I read my pitch book data and things every single morning. And, one of the things that's interesting that I tend to follow, and I just think, it's we'll see where it all goes, but there's two things that are interesting to me that are probably non-traditional. And I'll be curious, Jack, what your view is on this, but real world assets is one of them. And then the crypto market, right? So those are things that still seem a little bit wild, wild west, but I'm seeing more and more structures and I'm seeing more and more family offices becoming attracted to those structures. And I don't know if it's FOMO, like they don't want to miss out, or if they just want to get in. And then, I'm involved in sports and healthcare and things like that, and those all seem really hot right now as well. So
no, no, I think Dean, I think your points are very, very well taken there. And yeah, because we operate in the fintech space, we oftentimes see a lot of that, come through Cogent, and we see everyone wanting to create a coin, or because
token. Now it's a token.
yeah, or a token, yes. And whether or not that is a security, which, yeah, unless you're Bitcoin or Ether, it's a security. But things are also yeah, changing. The Clarity Act is in the process of being negotiated, and we'll set a few more guardrails. Um,
Yeah. Guardrails is key. And diversify your
Guardrails
investments.
is
For gosh sakes, don't put everything into one category. And don't put your business in one category. It's so easy. And oh, I want to mention this too, because nobody has brought it up. But AI, right? I mean, we all know AI is hot, but a lot of AI is not real. In fact, 90% of the deals that we get are not true AI, and yet they're saying they're AI. Well, just so everybody knows, FINRA and the SEC have chief AI officers that are forcing us to watch and validate and make sure if you use the term AI, you truly are generating your own AI. You're not just using AI. So you really have to be careful on the language there because that's getting some companies in trouble. I had one that is going through a judgment now, and it looks like they might. I just read this one, but they might have to give some of their capital back as well. So it's just interesting when you start seeing no different than when the dot-com thing was going on. We were all most of us were part of that too. Um,
I would just add to that, Dean, that we even see that on the legal side. State bar associations are coming out with new rules all the time, including here in Florida and in New York, to govern how AI is used in legal practice. I mean, someone just using Chat GPT to look at a legal issue or legal question, if they type in information that could lead someone back to their client, that's out there in the world. It violates attorney-client privilege, and some of the more advanced or legally focused AIs, they're designed to avoid those type problems. But with new technology comes all sorts of new issues.
yeah, that's excellent. I'm gonna fire through some of these only because we're getting short on time. So
Sure.
CJS as a startup investor, what would be some key responsibilities the CFO should focus on in the company's infancy? Fix your financials, make sure they're good. Pay attention to the balance sheet and the P&L. Make sure everything's real. I mean, I don't know
Well,
much beyond that. I mean, they should inspect everything that is either forward, forward thinking type statements or historical statements.
and I think there's a real partnership in most well-run organizations between legal and finance. When I was, chief legal officer of public storage, our CFO was, he was in and out of my office almost every day. Just comparing notes on various things when we were running an acquisition or what have you. I think that's a real partnership, within a well-run organization that needs to be in communication with each other, and not just when they're preparing 10Ks and Qs and other public filings. Um, Even private placements as well.
Yeah, exactly. I'm not seeing so much of this myself, but just in recent experience, how are investors reacting to non-U.S. citizen founders? I,
Haven't seen much negative there. I guess with the exception of I have had some clients with and I don't mean to single anyone out here, but clients who had ties to certain oligarchs in Eastern Europe and Russia, what have you. Those are things that that will be taken a very close look at by a regulator. One client was very interested in purchasing a bank in the U.S., who had some of those type ties. That was a hot topic and a real issue, that the Fed dug into very, very deeply. I mean, well beyond just the typical KYC. There are those kinds of issues, but it can depend on the industry. Banking and finance is one where I've seen it, and I've seen it be very real, or anything that involves national security, certainly.
right. Right. And then Forrest has a question here. I'm not sure that a founder, and we get this all the time, can respond to all of your suggestions and still respond to the overwhelming demands of a new business. How do you suggest they triage? Well, I would say, you know, unfortunately, if you're going to raise capital, you're in the business of raising capital along with your other business. So think of it as a side hustle, right? You have a day job and you have a night job and a weekend job. And you need to carve out enough time. But I think you also need to, this would be a test for your team to empower your team that's within the company. And I challenge, when we get an account, I challenge everybody on their team to see who can step in, who can step up, who can tackle necessary things that are required in a capital raise. And then there's folks like Jack and myself who have, we have best practices, we have articles, we have other things that, checklists, things that you can start off with, like, what am I heading for? Where am I headed? What's this going to take? But Jack, what do you think on that one?
No, I think every organization, has silos, if you will, of people with particular areas of expertise. Having been on the corporate side, you have IT specialists, you have HR specialists, you have finance, legal, and operations specialists, and no founder, can be an expert in all of those areas. So to the extent that I think support can be built up, and having the right internal team so that you touch all of those bases, and a few that I'm sure I haven't mentioned. Working on the marketing, the company's website, doing social media, on behalf of the company. These all require different disciplines and different areas of expertise, and some of that can be put together internally, and some of it's easier to outsource. So, just reach out to, a trusted advisor who has the expertise, and and who can relieve the burdens of the founders so that the founders can focus on some of the big picture items and the growth and strategies for the company. But it does take a good team there.
Yeah, absolutely. Other thing I want to address too is that um, capital, um, going to raise capital is not it's not a free deal, right? So you do have to budget for it, right? And so there's budgetary sides to set up whatever offering you're going to do. This is where Cogent comes in. And then there's on the security side where you need to make sure you're protected and somebody's watching your back, and that's where we come in. So there's low cost ways to do that. There's middle cost ways to do that, and there's expensive ways to do that. So the best thing you can do is just keep asking good questions like you guys are now, listening to advisors that are in the business and just see what breaks down and how it resonates for what you're doing out there. I think that's the best thing I can say about that. So
Yeah, no, I agree. Just looking at Ernest's question about, whether one can successfully raise substantial capital for not yet existing business. If the business is being reverse engineered from live historical performance metrics, I'm not exactly sure, the type of, performance metrics that he's referring to, but I think there is always, in a circumstance where it is a true startup without any financials, without any operating history, there's almost always in those circumstances, some deep-pocketed person, who is, ultimately standing behind the business, at least at the very beginning, and facilitating, bringing together the kind of experts and expertise that's necessary to address the issues that we were just talking about, all the various
yeah,
disciplines that need to be covered when you're raising capital. It's hard when you have no cash flow. And even a deep-pocketed, early investor, will and can at a certain point, get tired of just funding things, pre-revenue. Um, Although it can be done. Many businesses do lose capital, or lose money the first number of years. I mean, it's not impossible, but there are some obstacles to it.
yeah. And I would say a lot of times, just like in real estate, you've heard the term comps, right? So every business has a comp, even if it's a new business. You have to find something that's comparable to the business that you're building. And you know, you you want to try to draw parallels and advantages of why you're better, but then why you can succeed because that's the way this industry or this business succeeded, and you're following a similar blueprint, and then put your own spin and flair on that. So if you're a brand new startup, I would say that's probably one of the better things to do is to, let them know that you know what you're doing and you've done your homework. That's one of the biggest things.
No, I couldn't agree more. Couldn't agree more. Just looking at the last question, I think it's the last question
Yeah,
that's
it is the
come
last
in,
one, right?
asking, about ballpark figures on how, low cost, mid high services you mentioned founders should expect. I do think as the participant concludes, does it differ drastically by field? I think it can, and it does, but there are certain areas such as having solid, finance, person internally and eventually, a CPA or an external auditor, to review financials. I think when you're getting ready to seriously raise capital, it's critical, to have some audited, financials, that comport to, whether it's GAAP or some other, accounting discipline or metric. They're And there are law firms and there are accounting firms that serve a smaller market, to mid-market, just as, as well as, that service the large caps, the mid caps and what have you. It's hard to quantify though,
Yeah.
actual figures, without having more facts or knowing a little bit more about the industry or the business. I don't know if you had other thoughts, Dean.
Yeah, no, I totally agree with you, and it does vary, but just keep asking, and if you come to us or you come to Cogent, they'll tell you what the ballpark is for them, and at least let you know what it is up front or what to prepare for down the road. All right, so I think that concludes today's program. I do want to thank everybody that spent time with us, and thank my co-host Jack. It was uh, just a delight to do this with you. I've known you for a while now and talk socially and business with you, and it was a delight to be able to do this. So hopefully the audience felt like we did a decent job for them and gave them some, some good things to think about. And our email and phone numbers and that information is up there as well. So
Well, I second that, and I would also invite everyone who is on or who may be watching this on delay to join us next week and 2 weeks from now for the second and third session in this series, in which we'll be covering some additional topics that go deeper into the process of capital raising and that founders will typically encounter. And to the extent that there's a specific issue that you think we might be able to assist your business in, please feel free to reach out to myself or to Dean. Cogent, we're almost always willing to give you a 30-minute or so conversation to hear about a particular situation and see if there's a way that we might be able to assist.
thank you so much. And thanks again to everybody out there and have an amazing rest of your day. We'll see you on the next session. Thanks, everybody. Take care.
Thank you all.